Hello everyone. Today I'm going over the extra problems of chapter 7. I start with the problems related to bonds valuation. So the bonds issued by Stainless Stubs bear an 8% coupon payable semi-annually. So here there are two payments per year. Now the annual payment is equal to the coupon rate 8% times the face value of the bond. So the annual payment is $80. This means that the semi-annual payment is 80 divided by 2, $40. So here, $40 are paid each 6 months till maturity, year 11. I will have my final payment of $40 in addition to the face value of the bond, the 1,000. Now I need to find the yield to maturity given a price of the bond of 952. So now using my financial calculator, I have the following. 40 is the payment. 1,000, this is FV. 952, this is PV. And remember here that the present value will have a negative sign because the first two cash flows are cash flows from the issuer, from the corporation to the bondholder, while the present value is the price paid by the bondholder to the issuer or to the corporation. Then I have 11 times 2, 22 is N. I compute IY. I have 4.343. Now, this answer is not the yield to maturity. This is the semi-annual rate. So in order to get the yield to maturity, I need to multiply that answer by 2. So YTM equals 8.686%. Number 2, Oil Well Supply offers 7.5% coupon bond, again with semi-annual payments. So the payment is 7.5 times 1,000, 75 divided by 2, it's 37.5. And remember that I only use the coupon rate to find the payment. And that's it. I won't include that 7.5% in any further calculations. The yield to maturity is 7.68%. Maturity is in 6 years. I need to find the price of the bond given a face value of 1,000. So once again, I use my financial calculator. I have 37.5, this is PMT. 1,000, this is the future value. I have 7.68 yield to maturity. I need to find the semi-annual rate because I have semi-annual payments. So this is IY, 6 years till maturity. So the number of payments is 6 times 2. So N is 12. I compute PV, the price of the bond, 991.47. This is the price of the bond. I move now to problem number 3. Redesigned Computers has 6.5% coupon bonds outstanding. The current market price is 832. Yield to maturity 16.28. Face value 1000. Interest is paid semi-annually. This means that the payment equals 6.5 times 1000 divided by 2. The payment is 32.5. So 32.5, this is my payment. 1000, this is FV. The price minus 832, this is PV. The yield to maturity is 16.28. However, the 16.28, this is an annual rate. I need to divide it by 2 to find the semi-annual rate, IY. Then I can find the number of years till maturity. So I compute N. N is equal to 4.19. So I have 4.19 semi-annual payments. In order to find the number of years, I divide 4.19 by 2, and the answer is 2.1 years. Problem number 4. We have a 20-year zero coupon bond. This means that for this bond, the coupon rate is equal to 0%, and therefore the payment is 0. The yield to maturity is 8.68%. FV is 1000. I need to find the price of the bond if interest is compounded semi-annually. So now I have nothing for the payment. I have 1000, this is FV. I have 20 years, but because I have semi-annual compounding, I need to multiply by 2. So 40 is N. The yield to maturity 8.68 equals, so 4.34, this is IY. I compute PV, the price of the bond. The price of the bond is 182.8. So as you can see, in this case, the bond is sold at a deep discount because the investor is not receiving any coupon payments. So mainly all of the return of the investor, all of the yield to maturity is mainly a capital gain yield, because the current yield is equal to 0%. Number 5, once again we have zero coupon bonds, a market price of 319.24. This is PV. The face value is $1,000. The yield is 8.45%. How many years is it until these bonds mature? Here we didn't mention anything about the compounding. And because we do not have any payments whatsoever, so in this case, this is a case of annual compounding. Because there was nothing in the given that indicates otherwise. So in this case, 8.45, this is IY. I can enter the payment as 0. It's not a big deal whether I enter this value or not. And then I solve to find N. So compute N. N is equal to 14.07. Because I have annual compounding, this is the answer in years, 14.07 years. Now for number 6, a 16-year, 4.5% coupon bond pays interest annually. So the payment is equal to $45. The face value 1,000. What's the percentage change in the bond price if the yield to maturity rises to 5.7% from the current rate of 5.5%? So for this problem, I need to find the price P0, and this is when the yield to maturity was 5.5%. So 5.5, this is IY. I don't need to divide by 2 because I have annual compounding. $1,000, this is FV. 45, this is the payment. 16 is N. I compute PV. So the price P0 is equal to 895.38. Now I need to solve again to find P1, which is the price when the yield to maturity increased to 5.7%. All the other values are still the same, so I still have 1,000 as FV, 45 as payment, and 16 as N. I compute PV. P1 is equal to 876.19. Now, in order to compute the change in the price of the bond, so the percentage change is equal to the following: P1 divided by P0 minus 1. So I divide 876 by 895 and I deduct 1. The answer is minus 2.14%. So when the yield to maturity increases from 5.5 to 5.7%, the price of the bond will decrease by 2.14%. Another problem, we have bonds with 13 years to maturity, yield to maturity of 9.2%, price of 802.3, semi-annual payments. This time I need to find the coupon rate. Now, in order to find the coupon rate, remember the coupon rate equals the annual coupon divided by the face value. So as a first step, I need to find the payment and then find the annual coupon. I will use now my financial calculator to find the payment. So I start with 13 times 2, 26 is n. 9.2 divided by 2, this is IY. The current price minus 802.3, this is PV. And 1000, this is FV. I compute the payment. The payment is equal to 32.8. So now this is the semi-annual payment. In order to find the annual payment or the annual coupon, I need to multiply by 2. So I have 65.6. This is the annual coupon. The coupon rate equals 65.6 divided by the face value, 1000. So the coupon rate is 6.56%. Number 8, we have a 6.6% coupon bond, 9 years left to maturity, semi-annual payments. They're selling for 92.5% of the par value. So for this problem, the face value is $1,000. The bond is selling for 92.5% of the par or of the face value. So the price of the bond, PV, equals 92.5% times 1,000. The price of the bond is $925. Now, the effective annual yield, this is like the EAR, the effective annual rate. So in order to find the effective annual rate, I need first to find the yield to maturity, then find the effective annual yield, which is equivalent to the effective annual rate. Now, you won't expect a similar question on the exam. I will ask you here if you have this type of questions only about the yield to maturity. You won't be asked about the effective annual yield. So now, the payment is 6.6% times 1,000 divided by 2. So $33, this is PMT. 1,000, this is FV. And minus 925, this is PV. We have 9 years till maturity. So 9 times 2, 18, this is N. I compute IY. IY is equal to 3.887. Now, if I want to get the yield to maturity, I need to multiply this by 2. Now I'm asked to find the effective annual yield. Now using the EAR formula, the EAR equals 1 plus APR divided by 2. APR in this case is yield to maturity divided by 2 raised to the power 2 minus 1. YTM divided by 2, this is the semi-annual rate, 3.887. So EAY equals 1 plus 0.03887 to the power 2 minus 1. The answer is 7.925%. So this is the effective annual yield. Okay, problem 9. Northern Warehouses wants to raise 11.4 million. So in order to raise that amount of money, the company will sell 4-year 1,000 face value 0 coupon bonds. The bonds will be priced to yield 8.75%. We need to find the minimum number of bonds it must sell to raise the $11.4 million it needs, given that interest is compounded semi-annually. So in this case, the corporation will sell bonds to the public, to the bondholders. The bondholders will pay a total of 11.4 million. The 11.4 million is the number of issued bonds times the price per bond. So what I need to do is to find the price of the bond first. So to find the price of the bond, I have 40 times 2, 80. This is N. 1,000, this is FV. I do not have any payment because I have 0 coupon bonds, so the payment is 0. The yield to maturity, 8.75 divided by 2. This is IY. I compute PV, the price of the bond. The price of the bond, 32.529. So you can see that always 0 coupon bonds, especially with a long maturity, they're going to be sold at a deep discount. So you pay $32.5 now to buy the bond, and you will be receiving $1,000 4 years later. Now, in order to find the number of the bonds, so number of bonds equals 11.4 million divided by the price per bond divided by 32.529. So the number of bonds that needs to be issued by the firm is equal to 350,448, and this is the minimum number that needs to be issued in order to raise that 11.4 million. Now, the final problem that relates to bonds valuation. Costco issued annual coupon bonds 5 years ago at par value. On the day of issuance, the bonds had a yield to maturity of 10%, a maturity of 25 years. Today, the bond is selling for $1,200. I need to find the current yield to maturity on the bond. So now for this type of problems, I definitely need to draw the timeline because this type of problems is more complicated than the ones that we have seen so far. So here, this is year minus 5 years ago. Now we're here at time t equals 0. So when the bonds were first issued, on the day of issuance, the maturity was 25 years. This means that we still have 20 years till maturity. So whether I'm computing the current price or the current yield to maturity, the number of years that I'll be using is going to be equal to 20 years. Now, the second information that's very important here is what's mentioned here. On the day of issuance, the bonds had a yield to maturity of 10%. So here at year minus 5, the yield to maturity was equal to 10%. I add this information to the following information. When the bond was issued 5 years ago, the bond was issued at par value. This means that the price 5 years ago was equal to the face value. Whenever you see this phrase, the bond was sold at par value at this point in time, this means the following. The coupon rate is equal to the yield to maturity. So in this case, the coupon rate is equal to 10%. Because otherwise, if I didn't have this piece of information, I won't be able to solve the problem. So to repeat, whenever you see the bond was sold at par value, directly remember the coupon rate should be equal to the yield to maturity. So now because I have an annual coupon paying bond, I can say that 100, this is the payment, 1000, this is the face value. I have the current price is minus $1,200. This is PV. N is 20 because from this point in time, I have 20 years till maturity. I compute IY, the yield to maturity. IY in this case is equal to 7.9678%. Okay, now for number 11. So the outstanding bonds of the Riverfront Ferry carry a 6.5% coupon. Bonds have a face value of 1,000. They are currently selling for 10.29. What is the current yield on these bonds? Now the current yield is equal to the annual coupon divided by the price of the bond. So all the information that I need is already there. The annual coupon is 6.5 times 1,000, so the annual coupon is 65, divided by the price of the bond, 1,029. So the answer, 6.32%. Number 12 is very similar. I also need to find the current yield. So it's the annual coupon divided by the price. I have a 5% coupon rate. So the annual coupon is 50. The price is 984. So the current yield is equal to 5.08%. So those were two direct problems. In case you wanted to have a more complicated problem that relates to the current yield, the price may not be given, and you may have all of the information to compute the price. So when you are asked about the current yield, you may need to find the price first before you find the current yield. Now I move on to the problems that relates to the clean price and the dirty price. And for this type of problems, you always need to draw the timeline. So here, we have a bond with an invoice price of 1460. The invoice price, this is what we call also the dirty price. The coupon rate is 7.5%. There are 3 months to the next semi-annual coupon date. So let's see how to put those payments. Or let's say that this is year 1. This is year 0.5. I don't care much about when I have the maturity date. So every 6 months, I have a semi-annual coupon. The value of that coupon is 7.5% times 1,000 divided by 2. So every 6 months, we have a coupon payment of 37.5. Now, there are 3 months to the next semi-annual coupon date. This means that we are currently here. We have 3 months till the next coupon payment. So the number of months that passed since the last coupon payment is also 3 months. So now I need to find the clean price, which is also called the quoted price. Now, the dirty price equals clean price plus the accrued interest. So in order to find the clean price, I need first to find the accrued interest. The accrued interest equals the following. The number of months that passed since the last coupon payment. So it's 3 over the number of months, the total number of months between two coupon payments, it's 6, times the semi-annual coupon times 37.5. And remember here I'm using this 3 months and not the second 3 months. So the accrued interest is 18.75. Therefore, the clean price equals 1460 minus 18.75. So it's 1441.25. So that's the clean or the quoted price of the bond. Number 14, a 10-year 4.5% semi-annual coupon bond. So the payment is 45 divided by 2, 22.5. Face value 1,000. The bond is currently quoted for 987. So I have clean price is 987. What is the dirty price of this bond? What is the invoice price of the bond if the next interest payment will occur 2 months from today? So I draw the timeline. So the payment is every 6 months. I have a payment of 22.5. So here I have 6 months. The next interest payment is after 2 months from today. This means that I'm exactly here. So here I have 2 months. What I care about is the number of months that passed since the last coupon payment. So I care mainly about this 4 months period, because the bondholder who's going to sell the bond at this point in time has waited for 4 months without receiving anything. The new bondholder will wait only 2 months and will receive the full $22.5. So in this case, the seller of the bond will request, in addition to the $987, what we will call the accrued interest, his or her share of that $22.5 coupon. Because as you can see, the seller has waited 4 months out of the 6 months. So the seller has waited 2/3 of the time. Therefore, the seller wants to receive 2/3 of the 22.5 coupon. So in this case, the accrued interest, the additional price that the seller is requesting, is $15. Therefore, the clean price equals 987 plus 15 equals $1,002. Now for the last problem, the break-even tax rate between a taxable corporate bond yielding 7% and a comparable non-taxable municipal bond yielding 5%. This is what we need to find. So this is the taxable, 7%. The municipal bond, which is non-taxable, we have 5%. In order to find this break-even tax rate, the two bonds should yield the same rate after tax. Now, the taxable bond after tax is 7% times 1 minus T, the tax rate. The non-taxable bond will be equal to 0.05 because simply for that bond, T is equal to 0. So now I solve for T. 1 minus T equals 0.05 divided by 0.07. So 0.7143. T equals 1 minus that value, 28.57%. So when the tax rate is 28.57%, an investor will be indifferent between the two bonds. Because if the investor invests in the taxable bond, the investor will have an after-tax yield of 5%. And if the investor chooses the non-taxable bond, the after-tax rate is also 5%. So that's it for the problems that relates to Chapter 7. If you have any questions that relates to the lecture or that relates to the problems, you can ask me during our upcoming online session.